Morning, everyone, and thank you very much for joining me. This is the morning market review. My name is Russell Shaw, I'm a senior market specialist at FXCM. It's Friday, it's the 6th of January, and my email address is rshaw@fxcm.com. I'm just going to go ahead and bring up the high risk investment warning. As usual, can I just double check? Can you guys see me? Can you see the screen and can you hear me? Okay, excellent. Excellent. Hey, Indran, morning to you. Hey, Shadrach, Enoch, Katie, nice to have you on the webinar. Let's just bring up the market commentaries disclaimer. I'm looking at two screens, so if I'm not looking directly at the camera, I apologize. I'm just working with two monitors here. All right, our references, MarketScope 2.0, tradingview.com. We've got a live trade today. Got a live trade. I hope it goes better than last month's one. Last month's one was wasn't great. I popped the chat. I beg your pardon. I popped the link in the chat. So please register to join, and we'll see if we can make some money there. It's a very complicated situation that we're dealing with at the moment. I'm just bringing up the real rate. All right, the real rate. So this is really driving markets at the moment. It's the real rate. Why is real rates driving the market? Because it's all about whether there's going to be a Fed pivot or not. The Fed is adamant that there's not going to be a Fed pivot. I'm not convinced that they're correct. I think that the worst of inflation, in my opinion, is behind us. And I think that as the data evolves, hopefully we see that. There are risks out there. There's no doubt that there's risks out there. And because there are risks out there, this opinion may adjust, right? It's subject to correction. Hey, Howard. Morning to you. But what's interesting here with the real rate is if we start putting some labels in, just bear with me. So we'll put in a peak here. I'm just going to put a P. Here's our trough. Okay. And what I wonder is if we're getting a lower peak here on the real rate. This is the weekly chart, right? I wonder if we're getting a lower peak here, because that would suggest that there are perhaps market participants that are of the opinion that there is going to be a Fed pivot. Yeah, no worries. I'll put the live trade on Telegram. Yeah, absolutely. And of course, if we get this, then we would get the lower peak followed by the lower trough. Let's just go down. Just go down to the daily, because I think the daily is fascinating. So you're looking at the weekly. The weekly is all about if we get a lower peak. Let's go down to the daily and do some analysis there. Okay. And I just wonder if this is a flag. I wonder if this is a flag. Can you guys see that? Because if it is a flag, flags tend to fly at half mast, is what they tell us. So we could get a drop down here, right? If it is a flag, it's broken down already. What we've got to worry about is if this is going to be a higher trough. But to me, this could be a continuation pattern to the downside. That's important because now let's put in the Dow Jones. It's important because it's corresponding with the potential continuation pattern here. Okay, so we could get a breakout, assuming that the real rate is pushing down. What's the big deal here? The big deal here is the non-farm payroll. The big deal here is the non-farm payroll. If we go down to the 2-year, bear with me a moment, let's take this out. Let's just go down to the 2-year. And I want to go down, say, to the 1 hour. This guy here, you can see what I'm talking about, right? This guy here, what happened here? Okay, what happened here? So what happened was we had the ADP. Let me just try and get that data out for yesterday. We had the ADP data out yesterday. That's this guy here. ADP. So let me just explain what ADP is. ADP is a payroll system for smaller companies. And you can see the payrolls here came in at 235,000 as opposed to 150,000. That's incredibly strong. Okay, that's incredibly strong. Moreover, it's a jump from 127,000 for last month's print. And that basically reinforces the fear that the Fed's going to have to carry on raising rates. And that's reflected in this big jump up here in the 2-year yield. So what we've got is a very interesting day ahead of us. And I want to just stress the risk that's associated with the day. We've got the non-farm payroll. So coming through to today's calendar, non-farm payrolls over here. It's actually called the non-farm employment change. So they changed that, but non-farm payrolls, 330, right? 330. So I saw a forecast of 200,000. I saw a forecast of this one's 220,000. The whisper number is I think around about 235. Chris, I'm going to just try to send it to you personally. Does everyone have the Chris, can you email me? Oh, wait a second. Don't have to email. Control C. Let me just try to send this to you. Yeah. Did you get the link now, Chris? I'll just send it to everyone. Okay. Just let me know if you guys got the link for the live trade. Okay, cool. Alrighty. So this is very, very important now, because what's going to happen, in my opinion, and we're doing a live trade here, is if we beat the 220,000, I think that's going to feed into the narrative. I think that's going to feed into the narrative that the Fed is still going to be aggressive, and I think that's going to be net dollar positive. So we have to be very careful around that. But also, can you guys also take a look at the average hourly earnings? Okay, I want you guys to keep an eye on the average hourly earnings here, because if these beat to the upside, then I think we're definitely in for an aggressive Fed mentality, a risk-off type of environment. The Fed is petrified of getting caught in a wage spiral, and if we get this average hourly earnings pushing up, that could be quite interesting in terms of our live trade. Another thing, take a look at this average weekly hours. I'm going to show you guys something interesting. Okay, I'm going to show you guys something very interesting. Okay, we've gone back to trading view. Let me see if I can find it over here. Okay, look at this. Isn't this interesting? Okay, look at this. So there's this huge narrative that's been pushed into the market, and that narrative in the market is that there is a very strong jobs market, that there is people can't find the right employees, and that might be right, but we've seen Amazon's now announced they're laying off 18,000, but people are desperate to hold on to their employees because it's been quite difficult to find employees to fill roles. Now that they've filled the roles, so to speak, well, they're cutting down on their hours drastically. Okay, well, we've got to think, why would you be cutting down on hours? So eventually, if there's not some sort of turnaround, you can't cut down hours infinitely. So the job market is not as sturdy. It's not as sturdy as we're hearing in the media. The weekly hours here is the first part of a weak job market. So we're seeing a very, very obvious downtrend in the weekly hours here. And that's something that we've got to watch. It's something that we've got to watch. So again, I'm of the opinion that the Fed perhaps, I think they're talking the talk at the moment because they want to make sure that the conditions don't loosen up prematurely. Okay, but of the opinion it's just talk at the moment because the job market is showing signs of cracks. The inflation data is showing signs of moderation. So we've got to watch it carefully. Let's just take a look at some charts over here. This is the Dow Jones. There's some sort of broadening formation taking place. Let's get rid of that. It's confusing. Broadening formations are the worst because there's no trend. Okay. So now what we can do is we can start looking for some sort of pattern here. 1, 2. Okay. 2, 3. Okay. Is this the correction? Then the next one should be a 1, 2. Okay. If it's going to lead into the next leg of a bear, we should see a lower peak. So we've got this pullback here. At the moment, I'm viewing it as a correction. Take a look where the RSI is. The RSI is on the bullish side of 50. As long as it stays on the bullish side of 50, okay, this is probably a correction. If we drop below 50, then it's not a correction. If you go down to the daily, so we lost about 160 points yesterday, but we're actually still quite we're neutral at the moment. This is going to change very much dependent on that non-farm payroll. So if we get a non-farm payroll that is surprising to the upside, yes, we're going to drop into the weak area, which is between the lower blue, lower red. But if we surprise to the downside, there's actually going to be support here. That's counterintuitive. This is kind of where good news is bad news and bad news is good news. Very, very odd situation to be in, but that's kind of the situation we're in at the moment. So if you take a look here, there does seem to be some sort of bearish bias to it, just as this will be looking at Dow. Remember, we'll look at the DAX in a moment. Just as the European markets open, I think that this is probably not going to have legs until we get the non-farm payroll out. I think the market is terrified of this non-farm payroll. It's a very, very key. It's key. The data today is key. All right, let's take a look at DAX. Then we'll take a look at NASDAQ KD. Let's take a look at DAX. Okay, just bear with me. All right, so this is the DAX. The DAX is looking terrific. The DAX is looking terrific. This higher trough is in. Okay, we looked at the COPOC indicator yesterday. Okay, we looked at the COPOC yesterday. There's a nice turn up here. Look at this RSI. It's on that bullish side of 50. It's terrific. Go down to the daily. We're nicely in that zone 1. Okay, but again, we've got the data itself. Is it key? How it's asking key? Yeah, well, the non-farm payroll is the most, I think, anticipated data of the month. So yeah, it's key, but it's key today specifically because of what happened in the ADP number. All right, so we want to see what's happening with the ADP number, given the fact that the market expects a pivot, and given the fact that the Fed is absolutely talking that down. Again, so you can see the bearish, perhaps the sort of bearish start to the morning. I don't think this is going to have legs. I think the whole idea is what's going to happen with this non-farm payroll. So just be cognizant that if you put on your position and the data comes out against you, you're holding a risky position, right? So that's very, very, that's key. You guys must realize that. We're going to do 2 more charts. We're going to look at NASDAQ and we'll look at Euro. So let's just take a look at the NASDAQ. All right, so the NASDAQ is much weaker, KD, than the Dow. It's getting to the point now where we've got to be careful. It is an uptrend. It is an uptrend, but it's very close to losing this uptrend. If we take out this over here, we've lost the uptrend. Okay. Why is the NASDAQ behaving differently to the Dow? Because the NASDAQ is inherently a completely different index to the Dow Jones. The NASDAQ is made up of growth companies. The Dow Jones is made up of value companies. There's a distinct difference between growth companies and value companies. We're still in a very risky environment. Money is going towards the safer option. The safer option is the value companies. Why is that the safe? Because they're established. They've got dividends. They pay those dividends, and the growth companies don't pay dividends. They withhold the money to reinvest. It's inherently a different mathematical equation when we work out the time value of money. I don't want to get into the mathematics today. We can do it early next week, but I just want to double check. Does that answer your question, KD? As we've done the mathematics before, when the dividends is on the numerator and we put the discount underneath, the 1 plus the interest rates. So the NASDAQ is a completely different kettle of fish. It's a growth index Value is what's being sought after now. That's the safe option. Let's just go through to euro. And the euro is looking really strong. This is the weekly chart. We've got higher trough, higher peak, higher trough, higher peak. This we can actually move up here. It does look like it's pulling back now. So any sort of pullback here, to me, would be corrective in nature until proven otherwise. And if there's going to be any dollar strength, it would probably have to come out through a lower peak, if anything. But any correction here would be, to me, a dip in the uptrend. Okay, go through to the daily chart here. And you can see that the ADP has really hurt. Euro this week. Something's going to happen here. Okay, you've got a very tight squeeze. On the. It's compressing on the Bollingers. My analysis of that is, well, it's going to depend what happens with non-farm payrolls. If that non-farm payroll comes out to the upside, I think there is going to be an expansion to the downside. I think then Europe can get hurt quite badly. If the non-farm payroll comes out softer than expected, I think this is going to race back into zone 1. We're going to be trading euro, actually. So join me for that, for the euro trade. But if you go, even if we get a pushback here on the daily, so even if the non-farm payroll pushes to the downside, okay, it's still, to me, going to be corrective in nature. Why is it going to be corrective in nature? Because the trend's up, the primary trend's up. How do I know the primary trend's up? Go to your highest time frame, put in your peaks and troughs, higher trough, higher peak. Okay, higher trough, higher peak. Well, we know that the markets don't move in a straight line forever. They zig and zag. So there has to be a zag at some stage, right? That zag's a dip in the uptrend. What's the big deal here? The jobs market's not as strong as everybody's expected, as everybody's talking about. Those hourly average hours are coming down to a point where it's going to be impossible to hang on to those employees unless something changes. So we just got to watch it very, very carefully. Yeah, so there is, I mean, I can see there's an engulfing. There's been a strong sell down here. Don't use your technicals in isolation. It's not a wise way to approach the market. Technicals are driven by price action, but price action is driven by fundamentals. Okay, you've got to marry the two. Looking at it in isolation. Okay, so yeah, this is a big sort of I don't know what we'd call it. Here's your bearish engulfing. This would call a bearish Maruba for a long. Yeah. Okay, so that's fine. So this part of the chart is bearish. Well, what does that mean? Well, it's bearish in an obvious uptrend. Well, what's bearish in an obvious uptrend? Most likely a dip. Okay. Well, what's causing the most likely the dip? Well, there has to be a Fed pivot. Okay. Well, how can there be a Fed pivot? Well, there has to be a moderation in inflation, and the jobs data has to show signs of cracks. Guess what? That's exactly what we've got. All right. So the idea here is we watch the job numbers. Does that crack seal up? Does it show? Does the jobs data today actually point to higher average hours? We'll get that data. We'll get that data. It's over here. Average weekly hours. It's coming in. Okay. Nothing is in isolation. Top down. From bird's eye view, down. Technicals only? No ways. Technicals with fundamentals must be that way. Okay. So that's the way that we approach the market. That's the only way we're going to approach the market. All right. Are there any questions around that? Please go ahead and type those in. We're going to We'll wind up now. Okay, we're going to wind up. All right, guys, join me for the live trade this afternoon. Looking forward to that. I hope it goes better than last trade. The last trade was really tough. We got stopped out pretty quickly, but we'll honor the stop losses, of course. Speak to you guys later in the day. Cheers.